So I think we're probably getting pretty close to an intermediate cycle low in the stock market. I know it doesn't seem like it because the market hasn't corrected very much, but we are nearing 4 weeks into this correction. So time-wise, we've covered a lot of distance. We just haven't really dropped all that much. There have been a few other times in history where we've seen this kind of a compressed sell-off, and what has happened in the past is that there really wasn't much downside risk. About 1.5% is about all the risk there was when these conditions have popped up in the past, and then it didn't take very long before the market recovers and moves back to new highs. As I've gone over in some of my previous videos, I think we started the final bubble phase of this bull market on election night. So intermediate cycle lows are going to be different during this last euphoria phase. Prior to that, intermediate cycle lows kind of tended to be sharp enough to scare people and turn people bearish. During the final euphoria phase, the bubble phase, intermediate cycle lows don't generally run very long or very deep, so they don't actually give traders a good entry. They terminate before people are ready to buy, and so what they do is they cause people to chase. Traders sit on the sidelines waiting for a correction, and then you get one of these kind of a compressed correction like we're having right now, and they keep waiting, looking for something deeper to unfold before they're ready to buy, and then when it doesn't occur and the market starts to go back up, then they end up having to chase, and that's what drives these bubble phase. That, and along with the public, starts to come into the market during the final bubble phase. So what I wanted to look at here is the McClellan oscillator, because it's a pretty good tool to use to kind of spot when these intermediate cycle lows are about to occur. Now, not always, but quite often, the McClellan oscillator will show some kind of a divergence on a second leg down during an intermediate cycle low. The bottom here on election night was one of the few times that it didn't. The market just turned and went back up. And as I've said before, I think this was kind of a manufactured low. I think the plunge protection team stepped in overnight and prevented the stock market from delivering a second leg down, which I think it would have. This terminated way too early. It should have had another week or two to run before this cycle was ready to terminate, but they just turned it right back around in the middle of the night. So the McClellan oscillator did not generate any kind of divergence on that bottom. But you can see right here, we do have a divergence brewing at this time. We got a severely oversold condition during this first leg down. We got a little bounce into the FOMC meeting, and now we've got a second leg down. But you can see the McClellan oscillator is the breadth is nowhere near as poor on this leg down as it was during this one. So I'll show you kind of what I'm talking about. So we've got an intermediate cycle low here back in October of 2014, and you can see there's a divergence here in the McClellan oscillator between this first leg down and then the second leg down, which bottomed in October. You can see that during that second leg down, the McClellan oscillator did not move to a lower low. You can see, it's readily apparent during this intermediate cycle bottom. We've got a second bottom here in end of September, almost the beginning of October. You can see a huge divergence in the McClellan oscillator during that second bottom. Same thing here for the 7-year cycle low in February. We've got the first leg down that pushed the McClellan oscillator to severely oversold conditions, and then the second leg down, the breadth was nowhere near as extreme as it was during that first push down. Same, not quite as extreme, but you can see here in May, or in June, I guess it was, the Brexit vote, a slight divergence in the McClellan oscillator here at that intermediate cycle low, and as I pointed out in the first chart, we've got a big divergence in the McClellan oscillator as we put in this second leg down. So I doubt that we're going to get a big correction. This is probably going to be one of those intermediate cycle lows where it just doesn't go very far, catches a lot of people waiting on the sidelines, waiting for something deeper, and then it just doesn't happen. I go over this in some detail in the weekend report, but I'll just brush on it here. Sentiment has been, well, ever since we got this 7-year cycle low, this completely reset sentiment, and the public, it just does not buy into this rally. Many traders assumed that we were starting a bear market right here. I of course was not one of them. Said all along this was not going to be the start of a bear market. It was the reset of sentiment that needs to happen for the final euphoric bubble phase of a bull market to begin. And I'll show you some examples here in a minute. But I've got a chart of this. I'm not going to post it here, but I've got a chart of sentiment, and especially retail traders, the public, the people that need to come into the market to drive a bubble phase, have gotten bearish when we had this 7-year cycle low, and they are still excessively bearish, even though we've had a huge rally out of this 7-year cycle low. So until retail traders really buy all in on this market, there is zero risk that we have got a final bull market top yet. So let me show you the last couple bubbles, and I'm going to show you what has to happen before the bubble phase can begin. There needs to be a big, scary correction that resets sentiment. That gets everybody on the wrong side of the boat, and that generates the fuel for the final euphoria phase, the final bubble. So you can see the last bubble in the stock market. That reset occurred at the 4-year cycle low in 1998. The Asian crisis, the long-term capital crash, big scary correction in the stock market. Everybody assumed that we were starting a bear market, but what it did was it reset sentiment, and it created conditions for this final bubble phase in the tech market, or tech sector. Here we have the oil market here and the CRB here. You can see this was the reset. It was the move down into that 3-year cycle low in early 2007. That reset sentiment, and that's what created the conditions for this final bubble phase of the oil market, and the huge inflationary spike here in the CRB, and that, along with the collapse of the real estate market, is what drove the economy into the second worst recession since the Great Depression. But again, here's the reset. Reset sentiment gets everybody on the wrong side of the market, and that's the fuel to drive the final bubble phase. And here it is in our current market. This is the 7-year cycle low in the S&P and in the Nasdaq. This was the reset after 6 years of the market going up and up and up. In order to set the stage for the final bubble phase, we needed to have a big reset, get everybody bearish, get everybody on the wrong side of the market, and then that would generate the fuel for the next leg up. And so that's what the 7-year cycle low did, reset sentiment. In the NASDAQ, I've showed you this before, we went up, we tested those 2,000 highs a couple times, big move down. Now that we've broken out, we're really starting to run to the upside. So I think we're probably not going to get a really big correction here. I think the intermediate cycle lows have changed now that we have started the final euphoria phase. I think the intermediate cycle lows now are just serving to keep people sitting on the sidelines. They don't go deep enough for people to get a buying opportunity, a chance to enter, and it's going to cause people to chase the market just like they had to do in 99 and 2000 in tech, and also in 2007 into 2008 in the energy markets. So I think the bubble phase has started, and I'm not looking for an exceptionally sharp move down into this intermediate cycle low. As a matter of fact, I think we're going to get our final bottom sometime next week.